4-step method to high performance trading is about bulletproofing your daily routines, your executions, your skill set, your mindset, and your beliefs to execute your edge trading in live time. Building your discipline and confidence in live time is how you will be able to produce those results consistently over the long term. The 7-step daily routine for high performance traders is about developing your process, your habits, your mindset, your beliefs, your skill set to master the markets. Bulletproof yourself for success and consistency over the long term. The links are in the description box below. They're both free downloads. Let's get started.
Good day, traders. Stacey Burke from Stacey Burke Trading, a combination of a mindset reset and a technical video today, going over some simple setups that have happened this week and just going back to our criteria of understanding, number one, signal days, what setup are you hunting, how instruments can come up on our watch list, and then whether or not they behave into the session you're trading for a best playbook trade setup. Simple entry criteria, entry, stop loss, and take profits. The thing about rinse and repeat is that it doesn't matter what market it is. It matters whether or not we have a setup where we have edge in the market. One of the signal days that we look for commonly is the inside day. The Canadian-Swiss cross-rate pair gave an inside day signal on Tuesday. These are New York closing charts, 4:59 p.m. New York time. If we zoom in here for traders asking the question, often they'll ask questions such as, well, what do you mean by an inside day? An inside day is a day where the high and low are inside of the previous day's boundaries. Seems simple, but just to clarify that, it's the high and low are inside of a previous daily range. That's one of our signal days from the playbook. Now, similar to other currency pairs and other markets that completely exploded outside of previous monthly ranges at the beginning of the month on tariff threats, etc., we have a market that broke out, pulled back, and collapsed and broke out again. So we have shorts down low in the market. We have an inside day. Page 69 in the playbook, we can look for false break reversals or trend trade opportunities. We'll look at 2 examples of both of those. Now, I keep repeating the phrase, what setup are you hunting? Because it's about rinse and repeat. And this template just demonstrates the importance of working from the levels and any instrument. And then, do I have a setup in the session that I'm trading? High and low of the day, week, or month, and what setup do I have? How is price behaving into the timing window? We're looking at a 15-minute chart. We have a market that has given us a signal day. We've broken out in our Asian window heading into our London session. This is a 15-minute chart again. Day 1, day 2, day 3, there are 2 types of trade opportunities that I will look for on a day 3, either trend trades or reversal trades. Now, both of these major pairs gave signal days. The Canadian dollar closed in breakout, and the Swiss franc also closed as an inside day. So obviously, traders who are trading in the London window may have filtered through their basket and had 3 or 4 instruments setting up on their watch list and watching how price behaved, and as I've mentioned in the past, choosing one. You can have 3 or 4 instruments and then narrowing it down to what I would consider to be the highest probability templates on the day. And that comes from experience. Often pairs also that may offer more volatility. Now, when we come into our timing window, we've got Asia now breaking outside of our low of day level. Now, the basic model for trade entries is designed to keep things very simple. Now, what is happening with a lot of traders is they just want to get into the market right away because they've got a potential setup. They can't wait. They got to get in. And inevitably, they're not even into the right setup yet. It's just setting up as the timing window begins. And we've talked about this, having the patience to sit on your hands and let the market set up. So we have a thesis that this could be a false break reversal trade setup on our inside day signal. Again, page 69 in the playbook. And I encourage traders to get away from just trying to watch every little zigzag and bar in the market and start paying attention to the clock, the time of day. So we have our London open at 3 a.m. New York time. We have our thesis in place. We've already broken out of our inside day level. Now the market is going to give us one of 2 types of setups on the day. We're down low, so we're looking for the dump, coil, and pump template.
And why is that? Because we're going long. We're looking for the market to dump down and coil as we see our inside day level has been broken, coiling into our timing window, triggering new shorts into the market. We've got shorts potentially trapped now if they've traded the break of that low of day level on the inside day. A little higher high, a dump and pump into our timing window. That's what we're looking for. And we put the basic model for trade entry criteria, page 29 again, to keep things simple, to remove the analysis paralysis, paying attention to the clock. If they dump it down, we're thinking 30 to 45 minutes, potentially locking in the low of day or low of session level for the reversal. We have our large engulfment into 30 minutes into the session. Now our thesis is potentially intact. We put our basic model for trade entry criteria in. You can have a starter and your stop loss would be at the extreme. Now again, as this market's coiling, we can see another pin hammer. We're on the 5-minute chart. But most importantly, this is what I keep repeating to traders is once I have my thesis in place, I'm getting in. I'm going to place a stop loss. I can put it a fixed distance away from my entry. We've talked about having a max stop loss for different instruments, currencies, indexes, metals. Obviously, are going to have different volatility and different fixed stop losses. But in terms of locking in something inside of that large range candle, we can still use the extreme as our maximum stop loss if this trade fails. Now remembering, this is our worst case scenario, and as your skill set improves, obviously we can finesse our entries and tighten our stops up even more as this trade is coiling and beginning to now accelerate into the move. But once we have our thesis in place, some traders, the other part of this is what they're happening is they're going to break even right away. And the market, you can see, is pinned down and gotten traders who have moved to break even right away. Allow the trade time to break out. We've already got our thesis in place. It's dumped down, it's coiling sideways, and it's behaving as it should into our timing window. Entry, stop loss. Now we have to set a take profit level. Now I've just put my level on top of the very first candle of the day. We can put it at the high of the day. We can put it on our first swing peak. But also when we see this pin, if, for example, if traders have put it right at the extreme, the market's pinned up there. Now, it hasn't potentially hit your target. Now, what I will often do is I tighten it on top of the bodies. Why is that? For this exact reason. When a market can pin through, I don't want to have it go up there and not take me out, including the spread. So even if you allow for the spread, so that if it pins up into that level, it takes you out. But I will often use the tops of bodies, and that still gives us a fantastic risk-reward trade setup with a parabolic reversal, trapping shorts on an inside day false break reversal for a session trade. But the most important thing is just keeping things simple, allowing the trade to set up, not trying to count little bars and get in right away and get stopped out and get back in and get stopped out, and just be patient. Build your muscle memory through experience and repetition. This is a false break reversal on an inside day signal day setup during the London session. Very simple. Entry, stop loss, and a take profit level. And then locking in the money and walking away. If you had another trade, fantastic. Once they're executed, shut the computer down. Come back the following day, rinse and repeat. Look for other signals, whatever those signals are for your playbook trade setups. And then following the process, keeping it simple. If there's any instruments that are on your watch list, bringing them up. How are they setting up on the day? Has it already moved in an earlier session? So for example, the false break reversal in this setup has already moved in the London session. When I come to my US window, it is now chopping sideways in a range. This is not the setup now. We've already had the trade play out. That's it. We move on to another instrument that's on our watch list.
Now, two other major currency pairs that gave signal days were both the Swiss franc and the Japanese yen, both showing inside day signal days. So for traders in the Asian session, they could obviously peruse through their Asian cross pairs. But when we have two major pairs like this showing signal days, we may have an opportunity, if there's any disparity in one of the sessions showing up or on the cross pair, for a potential
trade setup opportunity. Swiss yen cross pair closed in breakout. Now this market's been in a strong breakout from the beginning of the month in a first green day template. Now I just want to keep repeating about focusing on simplicity, just having a simple think about why these setups might work. It's about having traders trapped on the wrong sides of markets. Now we just saw the inside day. We have markets that trigger new breakouts. So breakout traders are trapped on the wrong side. That market reverses quickly. Now they could be trading on the smaller time frames. They may be trading on the higher time frames. But when we get signal days and it sets up properly into our timing window, how does price behave? And it should happen very quickly because they have traders trapped on the wrong sides of the markets, whether that's a trend trade or a reversal trade. Now we have a market that's in a strong breakout. We've broken outside of a previous monthly level from January. That market has broken down and closed in breakout on Tuesday, day 1, day 2. There's our opening range and initial balance. This market may now be potentially coiling for a revisit back into the extreme, trapping shorts down low. That's the rationale behind the setup. It's a strong breakout. It's not we're trying to counter trend a market. So often traders are just trying to constantly counter trend, sell something because it's up high. But what about when traders get trapped in a strong market on the wrong side of the move? We come into our session in the Asian window and lo and behold, we have our nice beautiful pin hammer right at the open of the session. Now traders have, just even with the higher time frame, have the same entry criteria. Pin hammer, we can place an entry into the market, a stop loss, and a take profit level. Whenever I have a large candle like that, I will just take a 200% expansion of the range, recognizing this as a potential session trade. And why is that? Because we're now in a market that may be rolling over. We've put in a peak formation. We've broken a previous monthly level, which can be demonstrated by the green line. Now, most importantly, again, it's about keeping things simple, recognizing we have lower level shorts trapped in the market. We've broken down, coiled, and continued to fade into the end of the day. We can see a level project across that if it gets through that level and we're near our profit target, it either takes us out or we may look to aggressively tighten our stops up because this is a session trade. We want to lock in the money and be done with that opportunity. And just keeping things simple, that's a 100 pip range we're targeting back into where that market is broken down. It's a session trade opportunity. Keeping it simple. We had two major pairs giving us signal days and a cross rate pair that gave us a signal day as well, heading into our Asian window. So there's two examples of just using the major pairs to identify potential signal days, and then maybe one of the cross rate pairs has a cleaner template on the day. If you miss one or you don't get the perfect one, that's okay. But build your muscle memory on the best quality templates so that when you have an instrument setting up, you understand how to execute that trade in live time. We had a market that closed in breakout. We had two higher time frame signals from our major pairs. We have a beautiful pin hammer, whether you're long or short, simple process, pin hammer, entry, stop loss, a break-even level if necessary, if it's a longer trade, or a take profit level. Now here's the thing. You can make it as difficult or as hard as you want. If you're looking for trades all the time and you're counting pushes and looking at little bars and marking up all your charts, here's what I want you to think about. I make jokes about the matrix because that's what the matrix is. People are inside of the matrix and they're marking up all these little charts when in reality, everything inside of there is the matrix. What they need to be concerned about is what's going on outside of the matrix. Entry, stop, and a take profit level. Those are the only three things traders should be worried about. Counting little bars and marking up charts and gaps and sweeps and everything inside, that's the matrix. That's what they want you to see. And it's whether or not do you see the setup. If you don't see the setup, go to your next chart. Now there are certain setups and certain days that if you're on the inside, you're in the matrix. And there's people teaching you about how to read everything in the matrix, and except that the matrix is designed to get you into the market before they actually trap and shift, like my friend Steven says. Certain setups need the markets to break out first. So counting little bars and little pushes and measuring gaps and sweeps and everything else is for the smart people. Only the smart people can figure that out. Simple rinse and repeat setups, as we've just witnessed, show up every week on multiple instruments. And they're simple, they repeat, and they can be scaled up in size. But if you're chasing stuff or you're looking for trades just because they're up high or down low, you've missed the point completely. Step back, hunt out signal days. Sit on your hands, go through your basket. Which ones are setting up into your session for easy, simple, rinse and repeat trades? If you can't figure it out and it's not simple, there's something wrong. Go to the next instrument. Step back. If it's not simple and it doesn't behave the way that it should, Monday, Tuesday, Wednesday, reset, Wednesday, Thursday, Friday, why would you want to try and catch a move or get a trade that's 50-50 where you can sit on your hands and wait for a signal day and then watch how price behaves, and when they move quickly and fast in one direction because they have traders trapped on the wrong side on all time frames in many cases. But aligning yourself with that higher time frame thesis, sticking to the plan, keeping it simple, rinse and repeat, ignoring everything else and doing nothing else self-sabotaging or damaging in between. Rinse and repeat. Signal days. How does it set up into the session that you're trading? If it's already moved, go to another instrument. Find the best candidate for your session. And in between, sit on your hands and be patient. Keep it simple, traders. Rinse and repeat. Scale it up in size. And may the markets go with you.